does it seem to you like they are emphasizing one over the other of their two mandates? Does it seem to you like they're maybe now a little more focused on inflation than full job creation?
Up until yesterday, I would definitely have said that, yes. I mean, certainly they've never said, of course, we've abandoned our price stability side of our mandate. But if you listen to the rhetoric, the speeches and so forth, it's all about full employment, the benefits of full employment. Let's get back to the full employment we had 2019. We're not going to raise interest rates just because we have low unemployment. So understandably, the market sort of waved off a lot of the incremental news that seemed bad for the inflation side of their mandate and focused on the employment side. We saw Powell yesterday start to recalibrate that a little bit. And there was also another interesting innovation, I think. Powell also several times said that their whole story is that this rise in inflation is transitory. It's a few sort of like bottlenecks and supply shocks, et cetera. The quick question is, if that transitory rise in inflation starts to raise public expectations of inflation, that's a real problem because those expectations can become self-fulfilling. And they might have to respond to that. And that, in some sense, means that they would have to abandon the plan A, which is wait till unemployment gets below 4% and start to move right now. It's not at all the base case. Powell was emphatic about that. But I think it's sort of an escape clause in their plan that the markets until now have not really been that aware of.
Greg, to what extent do you think this adjustment in the way the view is presented, certainly reflected in the sort of consensus outlooks by a lot of the committee members, is a bit of a break from what Powell has been trying to emphasize for months, which is we are really going to be tolerant of the inflation side of things. We're very committed to this new mode of reacting only to outcomes, not to people's outlook. We're going to wait until it's right in front of us. And maybe that's why the market had to kind of shuffle its feet a little bit on this, because it's a little bit of a contrast with the note of emphasis that Powell and Brainerd and Clarida may have been presenting before.
Michael, I think that's exactly right. I don't think the market was prepared for the Fed to literally change its rate outlook just because the inflation picture had looked a little bit worse, given A, the emphasis on full employment, and B, the emphasis on outcomes. I think it's partly because they were thrown for a loop by the sequence of events this year. I mean, even though they say the Phillips curve, you know, the idea that as unemployment goes down, inflation goes up, even though they say that's an old model that doesn't work so well any longer, it's still kind of central to their view of the world. And the view of the world they've had for the past 9 months is that we're not going to get inflation sustainably above 2% until we have unemployment below 4%. They were not counting on this series of what I call freak events. You know what I mean? Shortages of semiconductors, shortages of lumber, you know, ships stuck in the Suez Canal, giving us this very high inflation rate this year. It's kind of, the economy, as it were, went off script. They're kind of struggling with that right now. They're trying to sort of say, we think that, you know, 6 to 9 months from now, things will go back to the way they were, that the old inflation picture will reassert itself. But they can't be certain. There's more risk out there than they were prepared for.
Greg, when I kind of think through everything, just given time to think through yesterday's decision, kind of play it all out, I'm kind of looking back at this and thinking, okay, this doesn't come as a surprise. I don't know that there's anything else they could have said without looking like they were completely separated from reality at this point. Is this a groundbreaking movement, or is this kind of a no-duh moment?
You know, at first I thought it was kind of a groundbreaking moment, but maybe like you, the more I thought about it, the more it felt like a no kidding moment. You know, it didn't take that many dots actually to move the median rate increase from 2024 into 2023. I recall I think a few meetings ago, there was some market expectation that it would move into 2023, and they just missed that by like 1 dot. So it didn't take a lot of movement by several committee members to get us where we are. You know, and like we were just discussing a minute ago, the outlook has been improving for a long time without that median dot changing. And in some sense, they're really just catching up to where the market already was. So I kind of think that after we've all had a little bit of time to digest this, we're all going to sort of come around to the way of thinking, well, yeah, you know, this kind of makes sense. And maybe that's one reason why, notwithstanding a little bit of, you know, indigestion in the markets yesterday, it really wasn't that severe a fallout.
Shepard Smith here. Thanks for watching CNBC on YouTube.